Welcome to the Energy Desk, a limited series from Mobius Risk Group on the macro and fundamental trends shaping global energy markets. If you like what you hear and you want us to keep this series going, make sure you let us know by following wherever you get your podcasts or dropping a note to Melvin@mobiusriskgroup.com. Let's hop in. All right, Zane, welcome back to another episode of the Energy Desk. It's good to see you.
Thanks, Alex. Good to be here. Nice quiet week in energy markets around the world, huh?
Yeah, not so much in some ways, indirectly related, I guess. But we've got a few things today on the macro side that are interesting, kind of in flux. And then I know we have some commentary on OPEC and other. So where do you want to kick it off?
Let's start with the, possible port strike in the U.S. I know you've done some work on what was being debated, and then we can kind of back and forth about what we think it might mean for the energy world.
Yeah, so the International Longshoremen's Association, they've been threatening this strike for several months now. For a long time, the industry side has been saying it's not going to be an issue. It's going to get resolved. And now we're about 5 days away from that strike starting on October 1st. And so what we're looking at is 45,000 dock workers who are implicated, 36 East Coast, Gulf Coast ports, roughly 3.7 billion in freight per day handled by each of those ports. The, indirect cost to a strike, add another billion and a half to that per day is kind of some of the estimates that are coming out. And so it's kind of one of those questions that we have where a disruption right now comes at an interesting time in the other macro landscape of the U.S., where we have the Fed just cutting by 50 basis points last week, 2 weeks ago on the 18th. And so what does that really mean? What are the consequences that we're looking for? Some of the things that I think are indirectly related, you have the union asking for an 80% wage hike over 6 years, as reported by others. You have some limitations on port automation, and really they're getting hung up on some of these disagreements here. And the disruption, considering, about 46% of the U.S. imports, container imports especially, are coming through these affected ports. That's going to be a inflationary element that's coming at a time when, after a 50 basis point cut, you're already going to have some predisposition to inflation rising to a level that's going to limit the Fed's subsequent rate cut action. So I think one of the issues that would come is, what is the relationship between the labor market side and inflation? So if this strike does happen, that's going to be massively inflationary for producers' supply chains. So input costs are going to go up. Where's that cost going to get passed on? Are they going to absorb it? If they're absorbing it, that's going to be something that's going to add pretty significant pressure onto the labor market side. If they're passing it on, that's going to be an inflation driver that's going to be limiting the Fed's subsequent rate cut action. So I think that's really the nuance there. I think there's some downstream effects that maybe extend into energy markets on a kind of nominal level in my eyes, but I'm curious if you have any other thoughts on how that ties to crude or any other side of the energy flows or energy consumption.
Well, I think simplistically, when you think of the loading or offloading of energy, whether it be LNG, liquids, crude, gasoline, diesel, and every other derivative that you might dream up, it's not a very labor intensive process. So, I think for energy markets, the read through for a potential strike, and I really highlight the word potential. We can go back to the Canadian rail strike that was imminent and was going to impact the flow of crude, from our neighbor to the north. They tend to have a way of getting worked out. Yeah. It's not good for anybody, but let's just say that it were to actually occur. Diesel consumption would really be the biggest, but very temporarily, meaning if there's just an inability to unload or load a container ship, means it's just sitting there. And if the engines aren't running, we're not burning as much diesel. So, in any meaningful duration or any meaningful quantity, it's not likely to have a substantial impact to energy markets. And, there was another comment in there that was pretty interesting to me from the ILA president. And That being when he mentioned that the International Longshoremen's members never stopped working in 2020. Correct me if I'm wrong about this, but it feels like at the time there sure was a lot of, oh, well, you can't get this good or that good right now because our ports are not operating at full capacity.
Yeah, that's a big component of the supply chain inflation that I think was one of the biggest drivers of the Fed even going into that 525 basis point hike cycle between 22, 23. And I think one of the, indirect consequences is where are those container flows getting redirected? And they're getting redirected to the West Coast. And so Port of Long Beach, Port of Los Angeles, both had record August months as importers were, facing the strike risk, but also facing issues with the Section 301 tariffs on China. So I think there's, the rail and freight consumption, you get some indirect increase in demand as people are having to redirect flows, transport across the U.S. But, to your point, I think that is transient and on the grand scheme, relatively immaterial considering what else is going on in the world of energy markets right now. I think one of the things to watch is, say this does get resolved before this strike really takes effect or, in a pretty immediate manner afterwards. I think there's several tailwinds that are going to be benefiting supply chain disinflation, namely what we're looking at for Asia to East Coast U.S. or Gulf Coast shipments. We're getting much improved flows through the Panama Canal. They've eased those restrictions. Water levels at Gatun Lake are restored to relatively normal levels. And when we're looking at real-time vessel traffic through the Panama Canal for September, when we're looking forecasting for the full month of September, we're back up to roughly 833 total vessel transits, which is still below the 5-year, it's in the 5-year bottom decile, but relative to, say, February, where we were at 559 vessel transits for the entire month. That's a pretty ratable improvement, so 49% improvement. And, that's just one example where you have Panama Canal easing. That's the preferred route for Asia to East Coast U.S. shipments. And so what's that going to do to the other side of, or the other route that shippers are using, and that's the Cape of Good Hope. That's the much longer route around the bottom of Africa, and we're seeing the vessel transit rates there are coming down to the lowest since February. So we're kind of having a give and take. I think that has probably an offsetting effect on any increase in consumption for rail or trucking to get a good from the West Coast to the East Coast. But I think there are some things just to monitor for non-energy markets, steel being one of those. We have automobiles. That's a huge part of it. Refrigerated shipments. I think there's a lot of consumer-oriented inflationary pressure that can come from this. And that's really returning that to the Fed conversation. What's that going to do to, say, the Fed's ability to cut by, 50 basis points if they needed to in November, for example. So I think that's really the touch point there. I think that also extends what's this, input cost look like for producers. And that's another point that we looked at this week with industrial activity. And we can just touch on this very lightly, where we have two pretty big U.S. and for Germany, European area industrial activity indices that came out this week. For the U.S., we have the S&P Global Flash estimate for the PMI. That one fell to 47 in September from 47.9 in August. And for listeners, the number there, really the differentiator. So 50 indicates the level of expansion if you are above 50 or contraction if you are below 50. And so when we're at 47, we're saying that's contracting manufacturing activity. That's the third consecutive month that the U.S. has contracted by the S&P's estimate. ISM has been much longer. And one of the interesting elements that really came out of the S&P one was that producers' selling prices accelerated at the fastest pace in 6 months. So that's, inflationary right there. Meanwhile, manufacturing payrolls fell at the fastest pace since June 2020. So that's COVID level payrolls declining right there. So, I think those are two indications that were repeated in the Richmond Fed's regional index for the U.S. So that's the fifth district for the Fed. Fifth Fed Reserve District, rather. And that, declined from negative 15 in August to negative 22 in September, another indicator of contraction. And same thing was repeated by the Richmond Fed. You have producer prices are increasing, employment is contracting at a rapid clip. And so I think those are really the dynamics that are worth paying attention to. Those have consequences to industrial demand as we get into the winter. 75% of the U.S. Distillate consumption comes from industrial and freight activity. So when those are contracting, that's definitely a bearish indicator for Q4, first quarter of 25 distillate demand. But curious if you have any thoughts to expand on those.
Well, I don't know. You had quite the run there. I'm going to try to simplify and stay on one specific topic that you kind of ended with there, diesel. So, we started talking about the potential impact to energy markets from a port strike. And we, went down to Panama and talked about Gatun Lake levels, flows through the Panama Canal, a lot of great color. And I would ask anybody to go out and check out Alex's research report on those latest industrial indices. To me, with diesel demand is really the tip of the spear for energy markets right now overall. There's some interesting dynamics to consider. First, we'll kind of go back in our near-term time machine. The idea when things really kicked off in October in the Middle East was that flows through the Suez Canal would be impacted. Well, I guess really we got to go back further than that when the Houthis started driving John boats around and firing rockets. The idea was that longer trade routes were going to be bullish for diesel demand, which was going to lift the crude complex. And here we are many months later, and we have seen very little in the way of diesel demand driving global crude markets. If anything, it's been lackluster. See U.S. diesel crack spreads of late versus the same period last year, or for that matter, even PADD 1 diesel inventory or the, New York Harbor market, which would be the NYMEX price point. So, in some ways, improving capacity through the Panama Canal, labor strikes being averted, there's some pluses and minuses in there. And in general, it would seem that if we're in this environment where overall industrial activity seems to be slowing, or at least the indicators would say that it could be slowing in the future, and we're reducing our trade routes, not great tailwinds for global liquids markets. You brought up OPEC in there at some point. I think it's almost impossible this week not to briefly cover the OPEC news from yesterday, Thursday, September 26th, where a Financial Times report came out stating what the market should have already expected, but it certainly got the attention of all participants. The headlines read that OPEC was reconsidering its stance on being the price police for oil markets. And really, that's not a lot different than what they had already signaled, meaning our barrels will start coming back online. If you go back several months, it was supposed to be in Q4. That got delayed a couple of months. And this article said that beginning December, barrels would start coming back. Well, I'm not exactly sure why one would have thought any differently, pending an update that said we are going to delay further. Or it's possible that the market did believe that the OPEC put, I'll say, the withholding of barrels would last in perpetuity, or at least until the mystery demand that we're all waiting for shows up. So That's really what's roiled markets this week. I think port strikes, industrial demand, what are our trade routes will all matter once we're looking back. But for right now, I think the energy markets in general are just kind of hanging on the edge of their seat going, well, what does a OPEC increase mean? And then the last comment I'll make on OPEC is it needs to be understood that most members of even the voluntary cut crew, not to mention the overall OPEC crew, have been overproducing to some extent. Some of the biggest outperformers, Iraq and the UAE, who somehow never gets mentioned on the list of naughty members who are doing more than they should. Instead, we hear about Kazakhstan. It's possible that OPEC could raise its voluntary cut level to simply match what has been produced. In one of our weekly strategy pieces we put out to our clients, we quantified that and showed that versus the voluntary cut levels, August production was actually about 1 million barrels a day higher than, what a full compliant crew would have produced. So, there's my little run on. There's one thing that I want to come back to a little bit. Panama Canal. It's an interesting one. And I think in some ways maybe can be tied to what we're seeing in terms of German industrial activity. I think in some ways we could be, right around the corner from some more significant population shifts. Where do people choose to locate? The German economy is not doing so well. Where would the German people find a new home? And I bring it up in the context of the Panama Canal because there's a little bit of a head scratcher. The Gatun Lake water levels are well covered. We've done several pieces on it. The data is available. So for anybody that's listening and you're curious about the recent history of flows through the Panama Canal and the correlation to Gatun Lake water levels, please reach out to Alex. And I'll just add my color to it, which I think is interesting. I went back to 2015, so essentially a decade's worth of data. And I can't find any year other than 2015 where the rainy season in Panama is May to December. So just taking the precipitation anomaly from May 1 through December 31, every year in the past decade, only one year, 2015, had below normal precipitation. In fact, one of the more recent years that was in this period of low Gatun Lake water levels was 2022, the only significantly above normal precipitation year. And which raises the question, well, then why are the water levels low?
Yeah.
Are there more people? Is the industrial activity there picking up? So, I think, over the next several years, as we've in some ways gone to a deglobalization sort of world, or at least a reshuffling of who are the important players, places, that weren't really on the radar screen like Panama are now very significant in terms of how do we move things. And not that the Panama Canal is new by any means, right. But the amount that we're trying to jam through it is pretty important.
Yeah. And there's a lot of talk too. I know Mexico is making some pretty big moves with their isthmus railway plans, trying to create an alternative to the Panama Canal, because this issue for Panama, whether it's agricultural water consumption, population consumption, or just pure drought, you see the impact on supply chains when that coincides with stuff like what's going on in the Red Sea, where you have disruptions there, disruptions in Panama. You have, Asia to U.S. shipments being forced around the Cape of Good Hope, super long route. And all those incremental costs are passed on to final goods. And so I think there's quite a bit of concern about what's the next move beyond Panama. I think that could be a very interesting deep dive to look into. I've done a few pieces on that for any interested listeners, but it does kind of raise the question, what is really driving that water level that we saw this year, because those reached record lows. So it does raise an interesting question. I think on the demand side, one of the things that came out this week that I'm curious to hear more of your thoughts on is what China did. So People's Bank of China came out, apparently kind of a rushed meeting, 48 hours of preparation after the Fed's cut the prior week. And they came out with a few different series of stimulus measures, but the first one that they came out with was a 20 basis point cut to their 7-day repo rate. So that's kind of their policy rate, down to 150 basis points. There's a few other measures that they did, but really The take I had was that it's a sentiment stimulus. It's something to drive more of the consumer-led demand, especially within their property sector. So it would take a little bit more than just this initial measure to drive a meaningful impact for commodity markets, especially for, say, industrial metals, because that's a big driver of China's use. So construction activity, things like that. But I'm curious, looking back at maybe some historical trends, some nuanced things that you've seen play out over the last several years. How did you interpret China's stimulus stuff this week?
Well, I agree with you. I think it's sentiment in some way. Personally, when OPEC began cutting production in October of 22, that felt to me like a big red flag. Like, wait a minute, we're just coming off $100 a barrel. We're saying that we're short BTUs everywhere in the world, and OPEC's choosing to cut. That didn't make any sense. That's not a good sign for what the global demand outlook really is versus the stated numbers from, say, OPEC themselves, the DOE, or the IEA. And I, would put this move in that same bucket, in that it's a bit of a Band-Aid if it actually is to be continued and is a real stimulus driver in any way. If you're having to take some, not yet, but at some point, extreme measures to prop up an economy, how lasting is that? Ultimately, it's going to be undone. And what's on the other side? I think for China, you kind of mentioned something there about the historical trends. The one to me that is really interesting, and not that crude market participants, or at least those with natural length, would be comfortable on the way there. But China does have a long history of going from a muted importer of crude at, a price level, that's high, a subjective statement. What's high? Well, where was it recently and where do we think it's going? We've got plenty of opinions on that. I won't try to get into that on this podcast, but if there is further downside, as, many did mention yesterday following the Financial Times story, if we truly are in a mid-50s, mid-60s crude market at any point in the near future, don't be surprised to see Chinese crude imports all of a sudden step up. And those that have, had to put their tail between their legs and having been wrong about Chinese demand, all of a sudden pound the table and said, see, I told you, here it is. Chinese crude imports are up. So China is turning around, and we'll point to this rate cut as a sign of it worked. I'd say, wise to pan out a little bit and say, wait a minute, is this really a change in demand? Or is this China, who's never going to report really what their equivalent of an SPR is? Or are they just buying crude when it's cheap?
Yeah.
So
opportunistic.
Yeah.
Yeah. I think there's some interesting thoughts maybe, on the crude side, as you just mentioned. I think metals responded pretty bullishly to that. So copper was a big one, iron ore. I think those, again, when I look at Shanghai inventories for all of these metals, they're above norm, whether on warrant, off warrant, et cetera. I think there's plenty of signals to say that it's a little bit more of a wait and see for me. And there's a lot of issues within the property sector that need to be resolved before that's going to pass through to any meaningful consumption of the raw materials, just for kind of fun numbers to throw out there. So August, the big one that really made people a little bit concerned was that home sales in China fell almost 27% year on year. And when you look at the official estimates for how much new home capacity, so residential capacity from a square footage perspective, China has 4.11 billion square feet of unsold new homes in July. And that's really what this measure was targeting, is they're saying, okay, how can we free up some of our commercial banks, for example, to go and kind of consume some of this surplus capacity? How do we get incentives for second-time home buyers, for example, to go and maybe get a larger home, get a new home, things like that? That's not a direct pass through to the commodity demand, and so I think that there needs to be a little bit more of a signal, I guess, in subsequent weeks, months, et cetera, to see if that's going to actually unfold as people are reacting to it initially. So it's definitely an interesting one to watch. But yeah, to your point, more opportunistic buying is probably the indicator.
Yeah, I don't think at any point in the near future we will take our eyes off of China. So, not discounting the moves made this week or saying that they should be ignored. This to be continued really is the summary here. Plenty of weeks and months ahead of, I guess, improving market conditions in China before they can once again step in as the global driver of strength in liquids markets. With you being okay with it, I'd like to wrap up a little bit today with a thought on natural gas, which we haven't covered much at all. There's an interesting setup, and we can pair this with the idea of global flow. And in this case, not the physical flow of an actual commodity, but just the global flow of spec positioning. There's an interesting setup right now where virtually every European liquid energy market has got excessive net spec short positions. Now, that may not necessarily be a net short, meaning the net length is a lot less than it has been historically. So whether it be gas oil or the European equivalent of diesel, European gasoline, Brent, the spec positioning is exceptionally short. And while the long position, the long holdings in WTI are very low, the extreme nature is not as pronounced. In fact, the Brent market itself is truly net short, which is very, very rare. Subjective statement, but we'll leave it at that for now. And so it presents an interesting setup. I think the market's come to believe with the Midland barrel now being part of the Brent basket that Brent and TI will remain linked. And while over extended period of times, we strongly agree with that thesis. For a moment, and certainly when driven by spec activity, they could separate. So it's worth contemplating what would happen if there was an environment where short covering showed up in mass in Brent separated from WTI, and European products were pulled higher by the move in Brent or actually led it for some reason. Now, clearly with the German industrial activity you talked about, doesn't seem highly likely. But let's just say the whole European crude, gasoline, gas oil complex had en masse short covering. Well, that makes a BTU in Europe that's non-natural gas far more expensive, which we saw in 22. That was what the initial driver was. It was power that pulled diesel, that pulled Brent, that ultimately had TTF pricing on the rise. So what does that do then for the U.S. natural gas market? If TTF rallies, JKM will inherently have to stay slightly ahead, not on a given day, but in general, it costs more. It's a longer trade route, even with the Panama Canal, to get a U.S. MMBTU of natural gas to Asia than it is to Europe. So if a spec short covering rally pulls TTF, which then drags JKM, or JKM has to stay slightly in the lead, does that lift Henry Hub going into the winter? And it's kind of fascinating when you think about the recent changes in curve shape, both crude and gas. You've got the WTI curve, the domestic crude curve flattening substantially. We've covered that in some of our recent daily reports and have it in our weekly strategy deck this week. While you've got the U.S. natural gas market quietly and slowly unwinding some of its record-setting contango. So I kind of leave that as a topic for maybe further discussion. And really to highlight the fact that we are quite possibly at a turning point for both U.S. crude and U.S. natural gas, with some important signals to be had from around the world on either side of our oceans bracketing us. Yeah, absolutely. And, I think this a little bit of a hint of what's coming next week. Have a piece on some LNG bunkering and the relationship between Asia's, the JKM summer rally there, how Japanese utilities have the lowest LNG inventories since April, and the Japan Meteorological Agency forecasting a cooler than normal winter. So I think that there's some interesting dynamics to watch, just as you mentioned. So we can leave it at that. It's just a little bit of a cliffhanger.
And again, just for reader or listeners who are interested in seeing some of the data, we'll put some links out for everything that we talked about here and come back next week with a little bit more on some of these trends that we're watching.
All right.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.